For years, one of the most powerful financial relationships in the world has existed quietly behind the scenes, China lending massive amounts of money to the United States. At one point, China owned more than $1 trillion of US debt, making it one of America's biggest lenders. But recently, something surprising has started to happen. China has been slowly selling its US Treasury bonds. And that raises a question that economists, investors, and governments around the world are asking. If China is stepping back from funding America, who is secretly paying for the United States' massive debt now? Is the world losing confidence in the US economy, or are new players quietly stepping in behind the scenes? Today on FiscalRelic, we're uncovering the hidden financial forces that are still funding the world's largest economy, because the real story isn't just about China leaving, it's about who replaced them. And the answer might surprise you. Let's break it down. For decades, China played a massive and often overlooked role in financing the United States government. To understand how important this relationship was, we first need to understand how government debt actually works. Whenever the United States government needs money to fund its operations, whether it's building infrastructure, maintaining the military, supporting social programs, or responding to economic crises, it raises funds by issuing securities known as treasury bonds. These bonds are essentially loans. Investors buy them, and in return, the US government promises to pay back the money with interest over time. Because the United States has the largest economy in the world and a long history of honoring its debt, these treasury bonds are widely considered one of the safest investments available. Governments, central banks, pension funds, and financial institutions around the world all purchase them as a way to store wealth securely. This is where China entered the picture in a very big way. In the early 2000s, China's economy began expanding at an extraordinary pace. Factories across the country were producing huge amounts of goods, electronics, clothing, machinery, household items, and exporting them to consumers around the world. But the United States quickly became China's biggest customer. Every year, Americans were buying hundreds of billions of dollars worth of Chinese products. As a result, China accumulated enormous amounts of US dollars through trade. The question then became, what should China do with all those dollars? Instead of letting that money sit idle, China made a strategic decision, began investing those dollars into US Treasury bonds. This move accomplished several things at once. First, it allowed China to safely store its massive foreign currency reserves. Treasury bonds were highly liquid, meaning they could be easily bought or sold in global markets. They were also considered extremely reliable because they were backed by the US government. Second, buying US debt helped stabilize China's own currency. By reinvesting dollars into American bonds rather than converting them into Chinese yuan, China was able to manage the value of its currency and support its export-driven economy. And third, this arrangement created a powerful financial cycle between the two countries. American consumers purchased goods made in China. China earned dollars from those sales. Then China used those dollars to buy US Treasury bonds, effectively lending the money back to the United States government. This cycle became one of the defining features of the global economy. As China continued running massive trade surpluses with the United States, its holdings of US debt grew rapidly. Year after year, its treasury investments increased, eventually surpassing hundreds of billions of dollars. By the early 2010s, China had accumulated over $1 trillion in US Treasury securities, making it one of the largest foreign holders of American debt. In fact, for a long period of time, China was either the number one or number two foreign creditor to the United States. This gave China a very significant presence in global financial markets. Whenever analysts discuss the stability of the US debt market, China's role was almost always part of the conversation. After all, when a single country owns that much of another country's debt, it naturally attracts attention. Some commentators even speculated about the possibility of China using its treasury holdings as a kind of financial leverage against the United States. The theory was that if China suddenly sold a huge portion of its US bonds, it could disrupt financial markets or push up US borrowing costs. However, the reality was always more complicated than that. China's massive treasury holdings were not simply a tool of influence, they were also deeply connected to China's own economic strategy. Selling them too aggressively could damage global markets and even harm China's own financial position. For many years, both countries remained locked in this economic partnership. The United States relied on global demand for its bonds to fund government spending, while China relied on U.S. assets to manage its enormous foreign exchange reserves. It became one of the most important financial relationships in the modern world. But like many long-standing economic systems, it wasn't permanent. Over time, shifts in global politics, changes in economic priorities, and evolving financial strategies began to slowly reshape this relationship. And what once looked like a stable, long-term financial cycle between the two largest economies on Earth has gradually started to evolve into something very different. In recent years, something subtle but significant has been happening behind the scenes in global finance. China, which once aggressively accumulated US Treasury bonds, has been slowly reducing its holdings. The change has not been dramatic enough to shock markets overnight, but the long-term trend has clearly shifted. Instead of steadily increasing its position as it did for many years, China has gradually begun stepping back. To understand why this is happening, we need to look at the broader economic and political environment shaping China's decisions. One major factor is the growing tension between the United States and China. Over the past decade, the relationship between the two countries has become increasingly complicated. Trade disputes, technology restrictions, supply chain competition, and geopolitical disagreements have all played a role in changing the dynamics between the world's two largest economies. During the trade war that began in 2018, tariffs were imposed on hundreds of billions of dollars worth of goods flowing between the two countries. At the same time, the United States began restricting Chinese access to certain advanced technologies, particularly in areas like semiconductors and artificial intelligence. These developments signaled to China that economic interdependence with the US might carry more risks than previously assumed. As a result, Chinese policymakers began thinking more carefully about their financial exposure to US assets, including treasury bonds. Holding large amounts of another country's debt can create vulnerabilities, especially during periods of political tension. Gradually reducing those holdings became one way for China to diversify its financial strategy. Another important reason behind this shift is China's desire to diversify its foreign reserves. For many years, the majority of China's reserves were heavily concentrated in US dollar assets. While this strategy provided safety and liquidity, it also meant that China's financial stability was closely tied to the strength of the US dollar and the policies of the US Federal Reserve. To reduce that dependence, China has started expanding its holdings in other types of assets. One of the most notable examples is gold. In recent years, China's central bank has steadily increased its gold reserves, signaling a broader effort to diversify away from traditional dollar-based investments. Gold offers something that treasury bonds cannot. It is not tied to any single government or currency. In times of geopolitical uncertainty, many countries see gold as a strategic reserve asset that provides long-term financial security. China has also been increasing investments in other currencies and financial instruments, spreading its reserves across a wider range of assets rather than concentrating them heavily in US debt. There is also a practical economic reason behind China's reduction in treasury holdings. Sometimes, China sells US bonds in order to stabilize its own currency, the yuan. Currency markets can be extremely volatile, especially during periods of economic uncertainty or capital outflows. When investors move money out of China, the yuan can weaken against the US dollar. To manage this pressure, China's central bank occasionally sells dollar-denominated assets like US Treasuries and uses those dollars to support the yuan in currency markets. This is not unusual behavior. Many countries use their foreign reserves to stabilize their currencies when necessary. But when a country holds a massive portfolio of US bonds, even small adjustments can appear significant in global financial data. It's also important to understand that China is not suddenly abandoning the US Treasury market. Despite the reduction, China still holds hundreds of billions of dollars in US debt. The shift is happening gradually and strategically rather than aggressively. Dumping large amounts of US Treasuries all at once would create serious problems, not just for the United States, but for China as well. A sudden sell-off could disrupt global markets, push bond prices down, and reduce the value of China's own remaining holdings. Because of this, China's approach has been careful and measured. Instead of making dramatic moves, it has slowly adjusted its portfolio over time while exploring alternative ways to manage its reserves. From the outside, this process may look like a quiet financial shift. But when one of the world's largest holders of government debt changes its strategy, even gradual movements can attract significant global attention. Investors, economists, and policymakers closely watch these changes because they could signal broader shifts in the global financial system. China's decision to reduce its reliance on US Treasuries is not just about bonds. It reflects deeper changes in economic priorities, geopolitical strategy, and the evolving balance of power in the global economy. Even as China gradually reduces its holdings of US Treasury bonds, there's one undeniable fact that continues to shape the global financial landscape. As US Treasuries remain one of the safest, most trusted investments in the world. This reputation isn't built on hype or speculation, it's rooted in decades of financial stability, global trust, and the unparalleled scale of the American economy. When investors, whether governments, corporations, or individuals, look for a place to park their money safely, few options can compete with US Treasuries. The primary reason is trust. The United States has a long history of meeting its debt obligations. In the eyes of the world, a US Treasury bond is almost synonymous with a risk-free investment. Even during periods of economic turmoil or political uncertainty, investors have continued to flock to Treasuries, confident that their principal will be protected. But safety alone isn't the only reason why Treasuries remain so appealing. Another critical factor is liquidity. The US Treasury market is the largest and most active bond market on the planet. Every day, trillions of dollars in Treasury securities are bought and sold. For large-scale investors, think central banks, pension funds, or hedge funds, this liquidity is crucial. They need to know that if they need to sell hundreds of millions or even billions of dollars worth of bonds, they can do so quickly without causing a dramatic price drop. Few other assets in the world offer this combination of size, safety, and liquidity. Another reason Treasuries are so coveted is their versatility. They can be used not just as an investment, but as a tool for financial management. Banks and other financial institutions use them to back loans, manage reserves, and stabilize balance sheets. Pension funds rely on Treasuries to match long-term obligations with guaranteed returns. Even hedge funds and global investors use them as a kind of financial anchor, balancing riskier investments with the stability of government-backed bonds. Treasuries also play a critical role in global finance because they are tied to the US dollar, the world's dominant reserve currency. Around the world, the dollar is the standard for international trade, investment, and central bank reserves. Owning US Treasuries isn't just about the bonds themselves, it's about having access to dollars that can be used anywhere in the world. This adds an additional layer of security and desirability that few other investments can match. Furthermore, during times of crisis, US Treasuries are often considered a safe haven. When stock markets tumble, geopolitical tensions rise, or emerging economies face instability, investors rush to buy Treasuries. This phenomenon isn't new. It has happened repeatedly over decades, from the financial crisis of 2008 to global uncertainty during the COVID-19 pandemic. The reason is simple: when the world is unsure, a US Treasury bond is one of the few assets people trust to maintain its value. Even with enormous amounts of debt, the United States benefits from this trust. Countries, corporations, and investors continue to demand Treasuries because there are few better alternatives for safety and liquidity. Gold, other currencies, and foreign government bonds exist, but none offer the same combination of scale, stability, and accessibility. This is why, even as China steps back from US debt, the market continues to function smoothly. Finally, it's important to note that the perception of safety is self-reinforcing. Because so many institutions trust US Treasuries, their demand remains consistently high. High demand keeps interest rates relatively low, borrowing costs manageable, and the US government's ability to finance spending secure. In other words, the trust in Treasuries creates a cycle. The bonds are safe because people believe they are safe, and people believe they are safe because they've consistently proven to be reliable over decades. This combination of a trust, liquidity, versatility, and global acceptance explains why, even with China reducing its holdings, US Treasury bonds continue to be one of the most sought after financial instruments in the world. No matter how much geopolitical tension rises or economic strategies shift, the bond market remains anchored by this extraordinary level of global confidence. As China gradually steps back from its massive role as a holder of US debt, other countries have quietly stepped in to fill the gap, ensuring that the global demand for treasury bonds remains strong. One of the most striking examples of this shift is Japan's, which has become the largest foreign holder of US Treasury securities. Japan's financial institutions, including its banks, insurance companies, and pension funds, view these bonds as a stable and reliable investment, especially in an economic environment where domestic interest rates are extremely low. For Japanese investors, US Treasuries offer not only security but also a predictable return that is difficult to achieve elsewhere. But Japan is far from the only country stepping up. European financial centers have also increased their purchases of US debt. Nations like the United Kingdom, along with key financial hubs such as Luxembourg, have been quietly building their holdings of treasury bonds. These countries are motivated by the same forces that drive Japan's stability, liquidity, and the need for a safe, reliable place to park significant amounts of capital. European central banks, as well as private investment funds operating across the continent, see US Treasuries as a cornerstone of global finance, providing a safe haven amid economic uncertainty. The reasons behind this shift are both practical and strategic. Economically, many countries continue to rely on US Treasuries because they offer unmatched liquidity. Large-scale investors, from sovereign wealth funds to multinational banks, need assets they can buy and sell quickly without disrupting markets. The US Treasury market, with its unparalleled depth and daily trading volume in the trillions of dollars, meets that need perfectly. Few other investment options in the world can handle this scale of transactions safely. Strategically, holding US debt also gives countries a degree of influence and financial security. Owning treasury bonds means holding dollar-denominated assets that can be leveraged in international trade, currency management, and reserve planning. For countries with large foreign exchange reserves, diversifying into US Treasuries provides both safety and flexibility. It allows them to maintain a balance between risk and stability while keeping a substantial portion of their wealth in an asset that is universally recognized and accepted. Another key factor driving foreign investment is the relatively low risk of US Treasuries compared to other global assets. While emerging market bonds or corporate debt may offer higher yields, they also carry significantly higher risks. Political instability, currency volatility, or economic turbulence can erode the value of those investments. In contrast, US Treasuries offer a nearly unmatched combination of safety and liquidity, making them an attractive option for countries seeking stability, especially in uncertain times. This international demand has also been reinforced by recent global events. Geopolitical tensions, economic slowdowns in other regions, and market volatility have made the reliability of US Treasuries even more appealing. When markets are uncertain, governments and investors often turn to these bonds as a safe haven. As a result, even though China's appetite for US debt is declining, the demand from other countries remains robust and, in some cases, has increased. Interestingly, this shift also highlights a broader trend in the global financial system. While China's reduction in treasury holdings initially raised concerns about a potential shortfall in demand, the reality is that the world's largest debt market is resilient. The buyers may have changed, but the fundamental trust in US Treasuries has not. In fact, the entrance of new diversified investors from Japan, Europe, and other regions has arguably made the market more balanced and less dependent on a single foreign power. These shifts are subtle and often go unnoticed by the general public, but they play a crucial role in maintaining the stability of the US debt market. Behind the headlines about China's sell-off lies a complex web of international investors who continue to support American borrowing, ensuring that the government can finance its spending without disruption. This quiet yet powerful network of foreign buyers demonstrates how interconnected the global financial system is and how shifts in one major economy can be offset by strategic moves elsewhere. While much attention is often focused on foreign countries like China or Japan when it comes to US debt, one of the most significant groups quietly funding America is actually as domestic investors. In fact, Americans themselves hold a substantial portion of Treasury securities, making the internal financial ecosystem just as critical, if not more so, than foreign holdings. This group includes as banks, pension funds, insurance companies, mutual funds, and other large financial institutions, all of which rely heavily on Treasury bonds to maintain stability, manage risk, and fulfill long-term obligations. Take as pension funds, for example. These institutions are responsible for ensuring that retirees receive consistent payouts over decades. Managing this responsibility requires investments that are virtually risk-free and predictable. US Treasuries fit this requirement perfectly. By holding government bonds, pension funds can match their long-term liabilities with equally stable assets. Without these bonds, pension funds would face far greater uncertainty and would need to seek riskier investments just to meet their obligations, potentially jeopardizing the financial security of millions of retirees. Insurance companies operate under a similar principle. They manage enormous pools of money to cover future claims and payouts, whether for life insurance, property coverage, or other policies. Predictable returns and minimal risk are absolutely crucial in this sector. US Treasury bonds provide exactly that, a guaranteed income stream backed by the federal government. For these institutions, treasuries are the foundation upon which their entire financial model rests. Commercial banks are another major domestic player in funding the US government. Banks often hold treasury securities as part of their reserve requirements and liquidity management strategies. Because treasuries are highly liquid, banks can quickly convert them into cash if necessary, giving them flexibility to respond to withdrawals, loans, or sudden market fluctuations. Holding treasury bonds also allows banks to strengthen their balance sheets, demonstrating stability to regulators, investors, and customers alike. Mutual funds and other investment vehicles also play a key role. Many funds, particularly those marketed to conservative investors, rely on treasury bonds as the backbone of their portfolios. These funds cater to individuals seeking low risk, steady returns, and treasuries are a reliable way to deliver on that promise. When millions of individual investors participate in these funds, their collective demand represents a massive source of domestic funding for the US government. One of the most fascinating aspects of domestic investment in treasuries is how self-reinforcing it is. Because US bonds are seen as virtually risk-free, institutions are willing to allocate significant portions of their portfolios to them. This demand keeps interest rates relatively low, which in turn makes it cheaper for the government to borrow money. In effect, Americans are indirectly financing the government while also benefiting from one of the safest investment options in the world. Even during times of market uncertainty, domestic investors have historically stepped in to absorb treasury debt when foreign buyers slowed down. This behavior demonstrates the robustness of the US debt system. While headlines often highlight China's selling or Japan's purchases, the truth is that domestic institutions provide a consistent and reliable base of demand that is essential to keeping the government funded. Ultimately, the role of domestic investors highlights a critical point. The US doesn't rely solely on foreign countries to finance its debt. Americans themselves, through a combination of institutions and investment mechanisms, form the backbone of treasury demand. Their participation ensures that even when geopolitical dynamics shift or foreign holdings decline, the US government can continue to borrow and operate effectively, maintaining financial stability both at home and across global markets. Beyond foreign investors and domestic institutions, there's another critical player quietly supporting the US debt market, the US Federal Reserve, along with the continuous global demand for US Treasuries. The Fed, as America's central bank, has powers and tools that no other institution possesses, and its involvement in treasury markets plays a massive role in keeping the system stable, especially during times of economic uncertainty. The Federal Reserve can act as a backstop in the market, purchasing large amounts of government bonds when needed. This mechanism, often referred to as quantitative easing, was deployed on a massive scale during the 2008 financial crisis and again during the COVID-19 pandemic. When the economy is in turmoil and private or foreign buyers slow down, the Fed steps in to ensure that the government can continue borrowing at manageable interest rates. By buying treasuries, The Fed essentially injects liquidity into the financial system, helping stabilize bond prices and prevent yields from spiking uncontrollably. But the Fed's influence goes beyond simply buying bonds. Its actions send powerful signals to global markets about the safety and attractiveness of US debt. When the central bank purchases treasuries, it reassures investors, both domestic and international, that the market remains liquid and that there is a guaranteed buyer. This confidence encourages continued investment in U.S. debt from other institutions, creating a reinforcing cycle of trust and stability. Global investors also play a critical role in supporting the Treasury market. Even as China reduces its holdings, other countries and large international funds continue to view U.S. debt as a safe haven, especially during periods of volatility or geopolitical uncertainty. When markets experience turbulence, be it in emerging economies, stock markets, or commodity prices, treasuries become the go-to asset for preserving capital. This isn't just a short-term phenomenon. Historically, during every major global crisis, from the dot-com crash to the Eurozone debt crisis, investors have flocked to U.S. government bonds as a secure store of value. This dual support system from the Fed and global investors creates a remarkable degree of stability for the U.S. debt market. Even when geopolitical tensions rise or certain large foreign holders reduce their positions, there remains a consistent baseline of demand that keeps borrowing costs manageable. The Federal Reserve's ability to intervene, combined with the steady appetite of international investors for treasuries, ensures that the U.S. government can continue funding its operations without facing a sudden liquidity crisis. The Fed's involvement also allows the U.S. to manage its monetary policy more effectively. By controlling the purchase and sale of treasuries, the central bank can influence interest rates across the economy. Lower rates make borrowing cheaper for consumers, businesses, and the government itself, stimulating economic growth. Higher rates, on the other hand, can help cool inflation or prevent the economy from overheating. In this way, the Fed's role in the Treasury market is not just about keeping the government funded, it's also a vital tool for guiding the broader economy. Moreover, global demand for treasuries reinforces the US dollar's position as the world's dominant reserve currency. Countries holding treasuries are, in essence, holding dollars which they can use for trade, foreign exchange reserves, or other strategic purposes. This worldwide trust in both the dollar and US debt allows America to borrow at historically low interest rates compared to other countries, giving the government a financial advantage few nations enjoy. Ultimately, the combination of the Federal Reserve's intervention and sustained global demand forms a safety net that underpins the entire U.S. debt system. It ensures that, even when certain players reduce their involvement, like China, the Treasury market remains liquid, stable, and trusted worldwide. This invisible but incredibly powerful support network is what allows the United States to continue issuing debt on such a massive scale without destabilizing its economy or sending shockwaves through global markets. So while headlines may suggest that China is abandoning U.S. debt, the reality is far more complex. China may be stepping back, but the world hasn't stopped lending money to the United States. Instead, a new mix of investors, countries, institutions, and even Americans themselves are continuing to fund the world's largest economy. And as long as the US dollar remains the dominant global currency, demand for treasury bonds is likely to remain strong. The real story isn't just about China leaving. It's about how the global financial system adapts when the balance of power begins to shift. And that shift may already be underway.